Pankaj Tibrewal joining us on the show right now. Pankaj, hi, morning. Winding down in 2019, do you think it's going to be as much chop and churn for the mid and small caps in 2020 as well, or do you think they'll finally play catch up to their large cap peers?
Good morning and good morning to all your viewers. We believe that last 2 years has been extremely difficult for the broader market, and we have seen a significant polarization in the large cap stocks, top 15, 20 stocks moving the index where it is. But the broader market hasn't participated, and especially the mid and small cap segment after having a phenomenal run in 2017. We believe that after the price and time correction over the last 2 years, there are some initial signs emerging which are showing that market is showing some signs of broad basing. Already October was the first month where we saw mid cap index outperforming large caps. November was again in line with large cap index. December has been some underperformance, but over the last few days we are seeing stock specific movements again starting to happen. Our view is that moving into 2020, we believe that a lot of negatives are priced into the broader market, and we believe over the next 18 to 24 months, broader market should outperform Nifty. And gradually we have been moving our money from the expensive large cap stocks to reasonably valued mid and small cap stocks.
Hear that. Where then, Pankaj, do you believe that the outliers would be in? Where do you actually see opportunity to buy into mid and small caps right now?
So ideally, if you look at this year as well, which has been a most difficult year, 2019, you will be surprised to know that in the BSE 500 list, there are about 130 stocks which have given more than 15% return. And the stocks come from various sectors. The best performing stock is from a renewable company. The second best performing stock is from a housing finance company, a sector which has been in the wrong for all the wrong reasons. The third best performing is a AMC. The fourth best performing is a MFI. The fifth best performing is a consumer electronics outsourcing company. The sixth best performing stock comes from a specialty company. So if you look at the list, and those 130, 140 stocks, they are coming from various sectors, and there's no sectoral theme per se. We believe that trend will continue over the next 12 or 18 months or so. Wherever there is earnings growth, where there is less concerns on the balance sheet, corporate governance, I think markets will keep rewarding that. Just to put a caveat, we are not expecting any kind of a rally which happened in 2017 anytime soon. We believe that market will be a stock pickers market, as we have seen in the last 2 years, and that trend continues because you will keep hearing about some of the other accidents in various companies where there's a concern on leverage or corporate governance.
Yeah, sure. About financials specifically, Pankaj, one has really seen that money has been made in the likes of a Bajaj Finance, or the corporate bank story really propped up. So you had the likes of ICICI Bank and Axis as well, see the churn. Specifically with banks, do you actually see that, the bottom-up story would actually play catch-up, or do you think largely it would be more beneficiary to stick by with these names, the larger ones, that is, because that's where growth is and that's where you actually see visibility of growth going forward too?
I think financials and banking is one area where with size the business gets better. And we have seen in various mega cap banks in India that size is not a constraint. Actually, it works to their benefit. For the first time, we are seeing, and whenever we are meeting the management of most of the bank, that the liability engine for most of the large banks is extremely strong. To the extent that most of the banks are started cut deposit rates and asking most of their branch managers not to accept term deposits or deposits in excess of 1 year, 2 year. So I think that's a very, very strong signal of the franchise these banks are operating. We believe to get some more confidence on the mid-tier financial names, you need to see whether risk is quantified or not. Still, it's completely opaque that what kind of a risk is sitting on a balance sheet of a mid-tier bank. And I think once that gets clarified, I think investors will have far more confidence on the mid-tier names, whether it be from banks or NBFC. Still, I think a lot of doubt is there that what kind of a slippages could come in the next 6-12 months, whether economy has passed through the credit cycle, this slowdown can spill over to retail or MSME or not. So I think a lot of unanswered questions. Once we start getting answers to few of the doubts and the questions, and that gets quantified, I think confidence will come back to the mid-tier banks again.
It's the start of a new year, and everyone's talking about how now there is more promise in place for mid-caps. That's something that you're alluding to as well. So within the mid-caps, what is on your checklist? What kind of companies, what kind of sectors is it that you will actively look at?
So if you look at the investment template, it's pretty simple, and the way we approach is that whatever outcome you see on the fund and the performance is a part of two inputs. One is your stock selection and another is your portfolio construction. On the stock selection, the investment template which we run is, first, we as a house are more focused on balance sheet and cash flows and not too much on accounting profits. Yes, earnings growth is important, but that is not the topmost priority. For us, top line is vanity, bottom line is sanity, and cash in bank is reality. There's no point chasing businesses which run for top line growth if it doesn't convert into profit, and there's no point looking at companies which only generates accounting profits if it doesn't translate into cash flows. So that's our first simple investing mantra, and by following this principle over the last 24 to 36 months, we have avoided a lot of mistakes and the accidents which have happened in the market. The second most important is the management quality and integrity, and we believe that ultimately we are piggybackers. If we can identify right set of management and promoters who have invested their lifetime investing in the business and generating wealth, and if one is patient enough, you can generate a lot of wealth for the investors in the portfolio. So I think that's the second most important assessment. The third is whether the business is able to generate capital returns which is more than the cost of equity for a longer periods of time, not for a shorter period of time. We have seen in many cyclical businesses, they generate higher return on capital for a short period of time and then fall below the cost of equity. Hence, they do not generate value over the longer periods. We get excited by businesses which take market share without diluting profitability and capital returns. So I think these are the few investing mantras which we follow in our stock selection, and that helped us navigate this difficult times of slowdown in the domestic economy.
It's lovely having you on board. Thanks so much for joining in and sharing with us your outlook for the markets, and we wish you all the very best for the brand new year.